Welcome back to Pro News Weekly. This week, the Fed has thrown markets a real curveball.
Yes, it really did. The US dollar and the stock indices are falling. Gold and Bitcoin, though, have weathered the Fed meeting.
Lots to get through. Let's start with the dollar.
So the dollar is under pressure. The Fed has really created some chaos. Investors are trying to work out what Kevin Warsh really means by shifting some of the central bank's workload onto their shoulders. Here's the logic. Rising Treasury yields and falling stock indices are tightening financial conditions. In theory, that should curb inflation. But without a rate hike, it isn't so easy to get inflation back to the 2% target.
So how did the dollar actually take all that?
Badly. You've got more hawks on the FOMC, a rally in oil and Treasury yields, and a falling S&P 500, and none of it is helping the dollar. The US dollar index posted its worst daily decline in 2 months. That came on signals from Kevin Warsh that the Fed is in no hurry to act.
Onto equities, and it was a rough week. The S&P 500 has plummeted, the Nasdaq 100 has entered correction territory, and the Philadelphia Semiconductor Index is falling for the 5th day in a row, as inflation worries compound inefficiencies among technology companies. The worry is that if the methods of Kevin Warsh can't bring inflation under control, more FOMC officials will vote to tighten. On top of that, the Middle East ceasefire has proved fragile, and Brent crude has turned higher again.
And this has been a rotation story for a while now, hasn't it?
It has. For several weeks now, the market has been driven by sector rotation. Strong earnings from the tech giants have actually prompted investors to sell those shares on the results and move the money into other sectors. But this time, the S&P 500 plunged outright. That was down to disappointing figures from Meta platforms, expectations of a Fed rate rise, and renewed escalation in the Middle East.
Let's move on to gold, which barely flinched at the July FOMC outcome. Short-term Treasury yields fell, while long-term yields rose. That's being read as a signal that the Fed will pause for an extended period. The futures market has scaled back its expectations of tightening, and together with the weaker dollar, that's supporting the metal.
Though there's a flip side to that support, isn't there?
There is. As the FOMC turns more hawkish and the stock correction deepens, gold is being used as a liquidity tool. Traders are now selling it to meet margin requirements on their equities.
Over to Bitcoin, which took the July FOMC outcome well. It's still being supported by capital flowing out of the technology sector. Small-cap companies have shifted money into crypto due to fears of Fed tightening. A weaker dollar helps too, and so do expectations that Congress will pass the Clarity Act.
And there's a headwind on the other side of the ledger.
There is. Rising Treasury bond yields increase the cost of holding Bitcoin exchange-traded funds. That's leading to some capital outflows. What's coming up in the week ahead?
The key event in the first week of August is the U.S. labor market data. Strong employment figures would increase the risk of faster inflation and make Fed tightening more likely, which would support the dollar. Weak figures would do the opposite. They'd fuel talk of continued inaction from the central bank and weaken the greenback.
Anything else on the radar?
Yes, investors will be watching developments in the Middle East closely, along with the ISM business activity data.
That's it for this episode. Stay on top of global market moves with Pro News Weekly.
Like, share, and subscribe, and we'll see you next week.